Good morning. It's Thursday, March the 12th. Here's what's on the agenda. Brent hits $100 again overnight. Redemption caps for private credit funds are all the rage. And tariff chat is back as the US embarks on its Plan B.
Well, this wild week for oil continues, Anna. Checking in on these markets, and we are just shy of $100 a barrel on Brent now, but we were above 100, as you say, on that reminder of the threat to energy infrastructure in the Middle East, a sign that this conflict seems to be only escalating. So futures lower on both sides of the Atlantic following the losses in the Asian session, and the dollar is up again. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7 o'clock here in London. It is Thursday, the 12th of March. And Lizzy, once again, we're talking about oil prices being substantially higher overnight. So 97.43 is where we trade on Brent, as you've just been outlining. And I really like the way that the Markets Live team were describing this, because we've had all this news around the IEA release from the strategic reserves around the world, including in the United States from the SPR. We've had all of that news, but that is not really scratching the surface when it comes to bringing down prices. And the Markets Live team saying that the markets are trading at the choke point, not the stockpile. And that really gets to the heart of what it is that is holding these energy prices up. It's all to do with the Straits of Hormuz. And if you just look at the last 24 hours, so many examples of how things have got worse and not better there. In Oman, they're clearing ships from their export terminal. We've seen in Iraqi waters, 2 oil tankers have been attacked, and that means that their terminals have stopped loading. And over in Bahrain, a huge fire at a fuel tank facility. So in all of these ways and many more, things getting worse and not better.
Yeah, John Authors had a great point to make, which was that Donald Trump can chicken out, declare victory and move on, but it'll only be a real win for markets if the Strait of Hormuz reopens, and that's in Iran's hands. Now, Goldman's warning that oil could beat its 2008 peak of $147.50 a barrel on Brent. BI modelling sees it going even higher. If the Strait is closed for 3 months, they see oil going to $164 a barrel. And as you say, neither side backing down right now. We had Trump at a speech in Kentucky yesterday saying we don't want to leave the job early, right? And vowing to finish the job.
Yeah, absolutely. And so, as you say, this is prompting many voices on Wall Street in the markets to talk about much higher oil prices. Goldman's, as we've mentioned, has been calling prices higher. Bloomberg Intelligence saying if this goes on for 3 months, we go over $160 on the price of oil. And also hearing from Goldman's that this could go over the 2008 peak. That was $147.50, unless we've forgotten where we got to during 2008. So these are the types of levels that we're talking about. If we look at the way that this is being priced into the futures curve as well, this isn't just a 1 month event. We have, of course, pressure at the front end, but we have December futures for Brent now up for 10 straight days, just underscoring the momentum and the conviction, perhaps, behind some of these trades in the market.
Next on the agenda, we should talk again about private credit. More worries in that space. Morgan Stanley and Cliffwater both capping withdrawals from their multi-billion-dollar private credit funds. Investors once again trying to redeem much more than their vehicles allow. And this following on from BlackRock last week deciding to limit withdrawals. So once again, underscoring that these private credit funds are focused on retail investors and they're not built to accommodate a rush for the exits, as we're seeing.
Yes, exactly. Where they have allowed retail investors in, that's raising interesting conflicts of understanding, I suppose, in some ways, about what these funds are supposed to do, how quickly you're supposed to be able to get hold of your money. I was looking at the Cliffwater, actually the particulars of the corporate lending fund that's been much talked about, the CCLFX. And they just say in very small letters that they are required to offer limited liquidity. And so retail investors, probably have been warned in the small print that this is what comes with private credit, but really have they internalised that? And we're seeing that flux and that playing in the markets. How much does this have contagion into other parts of the credit space is something we talked about yesterday. Are we going to see selling of more liquid quality corporate debt if you can't sell the private credit stuff and you want to reduce exposure to maybe any kind of private credit or to lending to software in particular?
Yeah, a Goldman exec rather uncouthly on a call to clients saying that, and this is according to the FT, private markets clients were very glad that there was something to talk about that wasn't software exposures and private credit because of the war, but actually the war in many ways feeding into these woes for private credit because of the talk of higher rates and the market volatility.
There is another way that this plays into the public markets and the public space, and that that is around issuance. The Markets Live team writing today about how Tuesday was a really big day for corporate issuance. And some of that is because private credits, that market is proving a little more challenging to get access to funds in. And so that forces some businesses into the public space to try and raise money there. So we'll see how the market seems to have appetite for it right now. But we'll see if that changes. Let's talk about tariffs, shall we? Seems as if, have we done that in 2026? I'm not sure. It was definitely very much the theme of last year, wasn't it? We have a new Section 301 investigation, and this is happening on a number of fronts. The aim of this is to replace the IEEPA tariffs. We know that the Trump administration put in place temporary tariffs of 10%, signalling they want to go to 15%, but those have been put in place, but they only last 150 days. So what are they going to do after that? Well, this is the answer. This is the plan, at least. And they're pursuing these investigations now on a number of fronts. And Jermaine Greer on the trade beat saying that they are concerned about capacity. They think that capacity has become untethered from market incentives and domestic and global demand. So they're basically accusing a lot of countries around the world of putting too much capacity into markets and suggesting this has been to the detriment of the United States. And what's interesting here is this list of countries includes China. We are going to see President Trump going to China, meeting with Xi soon. It also includes Mexico, and it also includes Europe. So a lot of really close trading relationships caught up here.
Notably, though, not Canada. But
yes,
as you say, it does risk stirring up tensions with Beijing right before President Trump's due to meet President Xi in Beijing in just a few weeks. But yes, this is the plan B, and really setting the stage to replace the tariff wall, rebuild the tariff wall after that Supreme Court ruling.
A number of sectors in focus there. And, this could focus on aluminium, on autos, on batteries, on electronics, machinery, plastics, anything that could be deemed as an important systemic industry, I suppose, many of those in that list. So we'll watch how this plays out and watch how quickly this investigation can be done, because that was one of the reasons not to go this way in the first place. Let's talk about some of the conversations we'll be having through the show. How are investors asset managers dealing with the volatility we're seeing in markets? We'll be speaking to Andrea Rossi, the M&G CEO, later in the programme. How is the retail environment holding up with all of these negative headlines? David Schroeder will be joining us, Zalando's co-CEO, so the German retail space in focus there. And Roland Kaloyan is the Societe Generale European Equity Strategy Head. We will also talk to him about what is happening in markets at around 8 o'clock this morning.
Let's take a look at what's on the agenda for us today. What else we're watching? At 9 a.m. London time, we have the IEA oil report, oil market report. Before, at 9:30 a.m, the Bank of England's Governor Andrew Bailey speaks at the Financial Stability Board Payment Summit. Then at 12:30 p.m, we have US jobless claims and the trade balance figures. And then the ECB's François Villeroy de Gallo is speaking at Bloomberg's Future of Finance Summit in Paris. We then have more US earnings, Adobe and Service Titan reporting after the bell. And of course, Anna, Adobe was one of the first tech stocks to be hit by the AI disruption trade. Interesting to see that stateside, because of the war, that software sell-off actually seems to have stopped, but not so much here in Europe.
Right, yeah, that is an interesting dynamic. And yeah, going back to the heart of this, the focus with Adobe, whether they or others like them are hit, has been very much around the annual recurring revenue. So we'll be watching that kind of number when it comes to Adobe to see what that tells us about the predictability of their revenue streams. Because moving from selling product after product to subscription models was supposed to be the answer for many software companies. But if you have tied your customers into such a degree that they don't want to pay it anymore, and then you get a lot of churn, then your ARR starts to not look so healthy, and that can tell you something about the sustainability of these underlying models. So we'll certainly be looking at ARR to see what that tells us about the sector.
Well, here's what else you need to know this morning. Bloomberg has learned that the European Union is warning inflation could pass 3% this year if the war in the Middle East causes Brent to remain around $100 per barrel and gas prices to stay elevated for an extended period as well. We understand that the EU's economy chief, Valdis Dombrovskis, told the bloc's finance ministers this week that under such a scenario, economic growth would also be as much as 0.4 percentage points lower this year than the 1.4% pace that it last forecast. Elsewhere, JP Morgan strategists say hedge funds are experiencing the biggest drawdown since the Liberation Day tariff turmoil. In a note on Wednesday, they said unwinding crowded trades have hit quants such as commodity trading advisors. Equity long-short hedge funds have also posted heavy losses due to their overweight positions in European and Korean markets and their underweight in software names. And speaking of earnings, BMW expects profitability to stay roughly flat this year due to the cost of tariffs and intensifying competition in China. The German car maker sees an automaking margin of 4 to 6% after the measure declined to 5.3% last year. Sales in China will remain broadly stable. BMW has been faring better on EVs than rivals Mercedes-Benz and Volkswagen's Audi, as it kept factory lines flexible to produce cars with different drivetrains. So we are looking to those BMW earnings, see how BMW fares at the open. Big picture, though, BMW is in pretty much the same boat as all of the German car makers. You've got to fend off the Chinese brands, undercutting them when you've got that luxury demand waning in China.
Yeah, absolutely. So BYD and Xiaomi, they seem to be the areas of intense competition. Also Tesla to some degree and in certain markets. But also the tariff story is in focus as well. And we've got some clarity from BMW on the extent to which that's going to impact their business. I mean, I say clarity, they have to draw the line somewhere and base these numbers on something. So whether this is post IEEPA, I am guessing so, but maybe it doesn't reflect any move up to 15% tariffs. Who knows where these things go next? But they are saying the impact on the automaking margin will be 1.25 percentage points this year as a result of the tariffs. And all of this at a time when the CEO is stepping down, been there for 7 years. So new leadership coming in, but such a lot of change in this sector. Coming up on the programme, we'll continue the conversation on BMW. We will bring you our interview with the CEO, Oliver Zipse, at 7:30 London time. Plus, how high can oil prices go? We will discuss the outlook for the oil market as the Straits of Hormuz remain effectively closed. But up next, we'll be joined by Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. If you have questions, if you want to get involved, please contact the team, IB plus BBTV Go. That is the function as the sun comes up in London this morning. This is Bloomberg.
Earlier today, the International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil from various national petroleum reserves around the world, which will substantially reduce the oil prices as we end this threat to America and this threat to the world.
That was President Trump speaking in Kentucky last night. Meanwhile, oil prices have remained volatile despite the announcement by the EIA to release 400 million barrels to combat disruption from the Iran war. Brent crude hit $100 again overnight, went above that level. That was after Oman cleared all vessels from its key export oil terminal and 2 tankers were attacked in Iraqi waters. Let's bring in Bloomberg's Jumana Basechi in the region for us in Dubai to walk us through the latest developments. Good morning, Jumana.
Good morning, Anna. Well, traders are turning their sights to the ongoing developments, and not just around the Strait of Hormuz, but also now what we're seeing is attacks taking place on the northern part of the Persian Gulf. So 2 tankers off the coast of Iraq. So this is way north of the Strait of Hormuz. Were set on fire this morning, reportedly ablaze. And then further south, also, this is also south of the Strait of Hormuz. Yesterday evening, the key port of Salalah in Oman was also struck. That's a fuel depot. You're seeing images now of those 2 vessels outside Iraq, but then equally some flames in the main export terminal in Oman as well. And earlier, out of an abundance of caution, vessels were asked to evacuate the area. Another key export terminal in the region, Oman, exports about 1 million barrels a day of oil through that port, and it is on the Gulf of Oman. It is not on the Strait of Hormuz. And so all this to say that the disruption that we're seeing isn't just around the Strait at this point, but also around the Persian Gulf and the Gulf of Oman too. So an alarming development. And of course, at the same time, the Trump administration has been trying to introduce various policy measures to help alleviate the stress on physical supplies of oil. The big announcement coming from the IEA yesterday, a record release of SPRs of up to 400 million barrels, but not making that much of an impact in the market. And I will say, when the executive director of the IEA, Fatih Birol, put out the statement, he said the most important thing is the resumption of the transit through the Strait of Hormuz, and that is clearly not happening. And just to give you a few numbers here as well, we're getting estimates from various banks, Goldman Sachs, Citi, suggesting that the amount of disrupted oil that is not being able to transit through the strait now is something between, let's say, 12 and 15 million barrels a day. Even if the IEA or the SPR were to go at their maximum capacity, that would amount to 4 million barrels per day. If history is a guide, they've usually gone at a pace of between 1.5 million to 2 million. So that pales in comparison, that 2 million barrels a day that they could release to the market pales in comparison to the, say, up to 15 million barrels a day that is being lost from not being able to transit through the strait. So there's a mismatch here between supply and demand, and then ongoing concerns about security and risk still for any vessels looking to transit the straits.
Germana, thank you very much. Stay safe. That's Bloomberg's Germana Bersecci. Well, we are looking at US equity futures declining following the lead of Asian stocks and extending what has been already a volatile week as oil prices have rallied after an attack on tankers in Iraqi waters, highlighting the threat to energy infrastructure in the Middle East and stoking concerns of an escalating conflict. Joining us now for analysis is Mark Anderson, co-head of global asset allocation at UBS Wealth Management. Good morning to you, Mark. I wonder, do you see anything sustainably lowering the oil price other than the reopening of the Strait of Hormuz? Because surely that puts the power in the hands of Iran and suggests that this could be a protracted conflict. And it doesn't seem the market's pricing that.
It certainly does look like it could stay to be a protracted conflict. And we're really working off two scenarios here. We have one scenario where we, within the next, say, month or so, would see oil starting to flow through the Straits of Hormuz. This situation where either through diplomatic measures or through some military intervention by, in particular, the US, would sort of allow oil to start flowing. That's a world in which we see oil prices moving back to a level of around $70 to $80 a barrel and not really having any significant impact on the global economy through sort of demand destruction or inflation rises. And then there's obviously a more negative scenario where oil prices will stay above $100 a barrel for, say, several months, 3 to 6 months, and therefore starting to have a real impact on the way we think about the economic outlook, central bank actions. And that's, of course, what we're trying to work with here for our clients when we construct portfolios, to try to think about, with these two scenarios, how can we somehow both insulate portfolios against some of these events for our global clients that are obviously challenged on one hand side, and also potentially see some opportunities as events they are unfolding here.
Well, how much upside do you see for US equities if the Strait reopens?
So we do think that we could see a rally back to some of the pre-levels that we were seeing before the strike. So we think we'd see a relatively quick move back towards sort of the highs where we were before. Very similar with bond pricing starting to move back, say on the US 10-year back around 4%. But as I mentioned before, the very challenging thing here for investors is certainly the fact that all of a sudden we have two of the main asset classes here, equities and bonds, which is typically the core parts of a diversified portfolios that are being hit at the same time. And that's what is making these supply shocks so challenging and why these sort of a heightened level of geopolitical uncertainty is difficult. One of the ways that we try to insulate portfolios from such situation is by going back in time to see what are the type of assets that will be, the most uncorrelated, maybe even be doing well in these sort of situations. And of course, it's easy to talk about commodities now because we see, Brent, WTI, oil prices are moving upwards. But on the other hand side, we also expect that gold prices will continue to be supported in this environment. We also have US dollars somewhat of a hedge these days. And then there's other portfolio elements like hedge funds, certain types that will be doing very well, inflation protected bonds. So these are the ways to try to insulate portfolios in times of heightened geopolitical uncertainty like we're in now.
Mark, good morning. We are watching European bond markets open up, and for the second time this week, digesting the fact that oil prices have touched $100 a barrel, even if we're just back down below that now. I'm just looking at the French curve, for example. We're up by around 5 basis points at the 2-year horizon, up at 3 basis points the longer end. What kind of higher yield environment are you starting to think about for the rest of this year? Or are you still base case thinking that for the whole year, we're not going to see higher yields?
So what the market is obviously pricing in right now is that when we're seeing higher oil prices, the risk is that inflation is going to to spike. And what we've heard now recently from the European Central Bank is somewhat more hawkish comments in the event that we were to see oil prices stay at sustained high levels, the same with natural gas. And that's sort of the place where central banks have to think about that part of the mandate where inflation shouldn't be getting out of control. And we would see these second round effects of inflation starting to spill over into other areas. But of course, when we start to think about what yields might be doing, there's sort of two phases here, right? So if we were to see inflation staying higher driven by energy, that would eventually lead to demand destruction. So as much as we're thinking about central bank hikes, maybe in an initial phase, eventually we would see demand drop and very likely we'd see inflation be coming down, left for central banks actually cutting rates. So I think, how to think about yield curves becomes a bit more complex than, say, the pure equities, where the direction is more clearly down if you were to see inflation staying higher. Where on the other hand side, bond yields might actually eventually be falling on worries about growth instead of only focusing on inflation as we're doing right now.
Yeah, bond market certainly focusing firstly on inflation, but as you say, Mark, that could change and growth could be at the forefront later on. What about emerging market assets then? Because emerging market assets have been very popular ahead of this conflict. Since the conflict, maybe a little more challenged by some of the dynamics, certainly around FX, but you still like some emerging market assets. Tell us more about where you're leaning into there.
Yes, of course, parts of the emerging market space is down at a time where we are both on one hand side seeing very cyclical assets being challenged. We've had part of the emerging market space in Asia doing particularly well. So I think there's a little bit of profit taking. And then, of course, if we continue on the track of Asia, very, very large importers to part of oil out of the Middle East. So these are areas that are being challenged these days. If we go on a little bit of a broader perspective here, we also have parts of the emerging market space that have attractively yielding currencies, some emerging markets that are commodity exporters that are doing reasonably well. So one of the investment themes that we have been having for our clients and something that we have actually added exposure to as this crisis was unfolding was around currencies that were higher yielding commodity exporters. So in the developed world, this has been places like the Norwegian kroner, the Australian dollar, but we have also been allocating to other places like the Brazilian real, Mexican peso, South African rand. So countries that, again, have commodity exposure, high yielding currencies, and we have used the opportunities of weakness to add a little bit of exposure here, balanced with some hedges by adding US dollar exposure as well.
Mark, thank you very much. Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. Thank you for joining us. And it's interesting, Lizzy, we are seeing yields go a little higher this morning. The market's still focusing on the inflation impact, to Mark's point. But it is possible that as this continues, maybe bonds start to play a different role if we're all worrying about demand and growth. Yeah,
and you wonder how portfolios start being rebalanced if those inflation concerns remain. It's interesting as well. We were talking about that fundraising by Amazon and how, when you're thinking about credit, perhaps you start going into corporate credit rather than treasuries as you look at these moves in the bond space. But yeah, not huge moves this morning when we're looking to what's happening in Europe. Yeah, we'll certainly look at gilts as they open up in around 35 minutes time and bring you the opening pricing there. Coming up, we're back to the corporate earnings story. BMW forecasts flat profitability due to the cost of tariffs and intensifying competition from Chinese rivals. We will hear more from the CEO. Oliver Zipse has been speaking to Bloomberg. That conversation coming up shortly. This is Bloomberg. Just under 30 minutes away from the start of the opening trade, and it's set to be a risk-off Thursday. Futures pointing lower on both sides of the Atlantic. The FTSE set to be somewhat cushioned by its exposure to energy. We have had Brent up nearly 5% to $96 a barrel on the latest events in the Middle East. Threats to energy infrastructure outweighing that record release of reserves by the IEA. Now let's get to the earnings picture. We are going to be watching BMW at the open after it said that it expects profitability to stay roughly flat this year due to the cost of tariffs and intensifying competition in China. The company's CEO told Bloomberg that there's been no impact on BMW from the war in the Middle East. Bloomberg's chief Europe correspondent Oliver Crook spoke with BMW's Oliver Zipse.
Any war in this world is utmost unfortunate. But currently, we must observe the developments very carefully. The situation is volatile, so every day we have a look at our supply chains, of course. But at this point in time, we don't have any interruptions towards our production or in the markets. But currently, it's too early, and everything else would be a speculation.
And at what point do you get concerned that it could have a bearing on your supply chains, on the deliveries of cargoes and the energy input costs for suppliers that could then trickle down to BMW?
We currently don't see that because the supply chains we depend on are not in the focus of current blockages. So currently we don't see that. And if that is going to happen, we will respond like we've always responded in the past years. We had in 2020 Corona year, after we had supply chain issues on the semiconductor side, we have energy issues, and so we will respond as always. We will have a very close look all the way from raw materials to the final production plant, and we kind of trained that muscle to have a very, very quick overview of what is happening. But again, currently we don't see any disruptions on the supply chain as we speak right now.
And I'd like to get into some of your forecasts for 2026. We know that they are obviously sometimes vulnerable to some changes, but in 25 we saw sales in China down by 12.5%, in the Americas up by 5.6%, in Europe up by 7.3%. Is that the trend that we're going to see going into 2026? What forecast do you see in each of these key markets? Could you break out? You said that there's also going to be growth in Europe and the United States. You guys didn't give a figure. What kind of growth can we expect there, and what do you expect in China?
Right. Stable. You know, it will be more or less in all the markets comparable to last year. That's why our guidance is on the level of this year. But this year we launched our Neue Klasse as well, which went here in Germany to the market just last week. We have really satisfying order intake, and we are very, very content about the future outlook of the Neue Klasse. And that will start this year and will continue next year. So overall, with all markets combined, we will see a rather stable environment overall at BMW. You know, and we don't have to change our strategy. You know, we will respond wherever markets have a demand. And we will respond on the electric side, we will respond on the high performance side, we will respond on the ultra luxury side, and also on the base segment. And that kind of gives us that stability. And neutrality helps. It's just very simple. Neutrality helps here.
Yeah,
yes.
And we're about a year since we got Liberation Day, the sort of big tariff relief from the Trump administration, or the big tariff reveal, I should say, from the Trump administration. A lot of chaos ensued after that. Now that there is a slightly more stable tariff regime, do you have a clear idea of kind of what this tariff picture looks like going into the United States, the effect that it has on the P&L? And now, basically a year from that, how does that govern your strategy in the United States? Are you now open to the possibility of opening new production lines? How are you thinking about strategy in the United States given the tariffs?
On a more global scale, we see more and more protectionist moves, which is, I think, which harms everybody involved. This industry is globally fully connected. And that's unreversible. So any form of protectionism, we have to consider, is that the right path for the future? Concerning your question towards the United States, at this point in time, we pay currently higher tariffs into the United States, 15%, but at the same time, we still pay the remaining 10% taxes, not the 0%, which was part of the Turnberry deal. And our request is, and I make that quite clear also in my discussions in the United States, to bring that down on the European side now to 0%. That would help a lot. But on the other hand, we are kind of protected because our largest plant stands in the United States, and whatever is in the United States, it's kind of naturally protected. And again, in 2025, we were the largest exporter of cars in value from the United States to the rest of the world. And our second demand is that we kind of build up an offset system Very simply speaking, for every car we export, we can import one. And that would create a lot of stability for jobs on the one side in the United States and also for global business models.
Fairly calm Oliver Zipse there, possibly the BMW CEO, speaking to our Bloomberg TV Europe correspondent Oliver Crook. That conversation in the results domain this morning. We'll certainly watch BMW shares at the open. We'll also watch shares in M&G, the asset management business, also reporting numbers this morning. Adjusted operating profit coming in ahead of estimates. The company says it is on track to achieve its target of 2.7 billion cumulative operating capital generation. We will focus in on that conversation now. I'm pleased to say we're joined by Andrea Rossi, who is the CEO of M&G, with us on set this morning. Good morning to you. Thank you so much for coming in. Let's start with the earnings picture then that you're delivering this morning, and then maybe get your views on what's happening in markets right now. The numbers coming in better than expected. What's the message to investors this morning along with these numbers?
Well, we're very pleased with the set of results. We have laid our foundation for profitable growth, and I'm particularly very pleased with the fact that our businesses are growing again. We had amazing net inflows on the asset management side with 7 billion of net inflows and quality inflows because we have it both in public assets and in private assets. We also continue to grow our life business, and we had 1.5 billion of sales, doubling our market share in the PRT market. And of course, we also saw strong momentum on our flagship PruFund fund with net inflows in the second half of the year. So very, very pleased with the growth, and that has been supported by amazing client outcomes. I mean, our investment performance for our clients have been stellar. In our public markets, 75% of our funds is in the first and second quartile. So very, very pleased with that. And that, of course, has given the very strong and resilient profit results. We are coming out with a dividend per share up 2% year on year. So very, very pleased with that.
So you're pleased with the inflow, so pleased with the amount of money coming into the business, and then you're pleased with what your colleagues are doing with it and on behalf of clients and how they're managing it. What do conversations with clients look like right now, Andrea? We are in an incredibly volatile environment. Last year felt volatile. This year feels even more so, perhaps. I wonder where investors are focused and what they're talking to you about. What do they want to bring to the fore?
Yes, I mean, the markets have been volatile since a while. I mean, let's not forget we had Liberation Day one year ago, and that created volatility. These are the time where clients are looking for an active asset manager. That's when an active asset manager makes a difference. Hence also why we had those great flows in 2025. And at the moment, obviously, it's early to say what this existing war is going to do. But clearly, it will create volatility. We see oil prices being at the top. We might see what banks are going to do in terms of rates. There is fear for inflation. So it creates a little bit of uncertainty, and clients want to see where they should invest in. That's why they come to us, an active asset manager. We diversify. We're strong in private assets. We're strong in public assets. We are focused on Europe and Asia. And we're having good conversation. At the moment, it's too early also to say whether the clients are risk off or not. At the moment, it's still very, very early. So,
if I could focus on the private side of the business, you've got one of the biggest private credit evergreen funds that's open to affluent investors in Europe. Have you seen higher redemptions so far this year?
Well, we have only one evergreen fund. It's our LTIF. It's on credit, corporate credits, and it's 1.1 billion. That's mainly seeded by our own life balance sheet, and it has institutional clients, so we haven't seen any redemption at all on it. And once again, when you're talking about redemption, I know the market is very focused on this, in particular on private credit. You have to make sure you match long-term with long-term investors. So as long as you have institutional investors, our own balance sheet, that does not create a problem.
Yeah, I do wonder how you view this balance between maintaining confidence and protecting those long-term investors. If you did see a rise in redemptions, would you restrict withdrawals?
Well, I mean, obviously, we're not in any way there. And as I said, when we have 80% of that fund is with our own balance sheet, so long-term liabilities, long-term investors, and the rest is institutions, we are not overly concerned on that. I think what you need to think about when you talk about private credit is in Europe, we're in a very different position than in the US. This is a much less crowded market. Only 30% is with capital markets asset managers. Banks still have a significant part of this. The US is completely the opposite. So the US more overcrowded, probably loosened underwriting, and therefore is that's why you see some of the problems. And of course, then there's the software exposure, probably much less software exposure here in Europe. And we have been in private credit over 25 years. It's not that we've been doing this for a long, long time. And we have experience here. So I'm not too concerned about where we are in Europe. And overall, if you think about this crisis, I think Europe is going to want to be more independent from an oil perspective. That's for sure. Whatever happened with the crisis in the Middle East, I don't think Europe will want to be unprepared anymore. So they're going to accelerate in terms of infrastructure, in renewable energy, etc. And of course, we know the governments are heavily indebted. So it will have to be capital markets that go for there. And that's a great opportunity for players like us.
So is private credit in Europe still a growth area then? Are investors still talking positively about it?
It is still a growing area. It's interesting, I talked to some of my American peers. They still feel that Europe is a better place than in the US. Many institutions are favoring Europe versus the US. And we have been in this market for very, very long. We have a 27 billion sterling franchise in private credit. So it is still very much a growing sector.
And coming back to the war, higher energy costs, of course, squeeze operating margins. At the same time, rate cuts are being pushed further out. How much pressure does that put on private credit borrowers?
Well, obviously, we'll have to see where we land. There are different scenarios when you think. Is inflation going to come back or not? It depends how long this crisis is going to be in the Middle East. We saw yesterday, of course, that the International Energy Agency did something very unique. 400 million barrels, it's a very, very big number. Unfortunately, you will probably only get 4 million a day. And between the Strait of Hormuz, it's probably 20 billion that transits. So there's still a shorting of 16. But depending on what happens, and I think here banks, obviously there are many central banks who are going to have discussions today and in the coming weeks. If there is fear for inflation, I guess banks might not cut their rates as quickly, and therefore we will have to see what might happen in terms of the curve. And yes, that might have some consequences on private credit. But still, let's not forget, when you're looking at private credit, the main investors here are long-term institutions, long-term investors like institutions. So they're there for the long term. It's not short-term deposits going after longer durations. So we have a better match. So less concerned about that.
Can I ask you about London, Andrea, because we've seen quite a lot of consolidation within the asset management space in London. I wonder what role you see for M&G, if any, in that consolidation, and what it says about London as a place to do asset management activity and other financial services.
Well, London remains an extremely strong place to do asset management. Let's not forget, we can attract the best talent here. We have a stable policies, and we have a very, very large capital markets. When you look at what the M&A activities have been about, it's mainly about alternative asset managers trying to get access to permanent capital, balance sheet. You look at our business model, it's exactly what we're doing. We have a strong, big 150 billion balance sheet supporting a very strong active asset manager. So we are delivering on our strategy. It's and obviously our model is a winning model. So we have a very strong independent future ahead of us.
All right, Andrea Rossi, CEO of M&G, thank you so much for joining us. A positive word there for London. Well, analysts are warning that oil prices are set to increase despite action taken by the IEA to release 400 million barrels from emergency stockpiles.
The damage is going to take months to unwind. But I want to bring it to the immediate. There is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. The maximum sustainable flow rate is 2 million barrels per day. So 400, that will take them 200 days to get that out.
That was Jeff Curry, Chief Strategy Officer at Carlyle Energy Pathways. We'll have more on the oil story next. This is Bloomberg. 11 minutes away from the market open, and the online fashion giant Zalando is gaining on Tradegate after launching a share buyback of €300 million. Revenue came in slightly stronger than expected in the fourth quarter, and the firm's also saying that Levi's is the first US customer for its business-to-business software unit. Let's now bring in the company's co-CEO, David Schroeder. Welcome to the programme, David. So it looks like you're going to be doing better this morning when it comes to the share price. What's your main message to shareholders this quarter? Because it has to be said, your stock is still well below pandemic highs. How do you plan to revive investor enthusiasm?
Yeah, good morning from Berlin, and thanks for having us on the show. We are obviously super pleased with the strong results we delivered for 2025. We are also looking forward to accelerate in 2026, particularly also driven by more and more AI-driven innovation. And we are firmly setting sight on our targets for 2028. And so there's much more to come from Zalando, and we think that will ultimately help us to get to the share price we deserve.
I'm sure we'll come back to AI, David, but I think I'm right in saying that Zalando doesn't have any direct exposure to the Middle East. But are you nonetheless concerned about the weight of higher energy prices on consumer demand, or perhaps are you having to monitor indirect effects on supply chains?
Well, most importantly, we haven't seen any impact yet on Zalando, on our customers, our partners. The spring-summer season has started super well for us. But yeah, we are obviously closely monitoring the situation, and we are preparing for all sorts of scenarios. I think we've shown in the past that our business model and our team are super resilient, and we were able to cope with many different dynamics on the macro side and also the geopolitical side in the past few years.
So just to confirm then, is there any concern around your supply chain, David, or is that not something that will affect your business? And what are you watching for in terms of consumer demand? Where might we see any weakness coming through in consumer markets?
Well, we're not worried about our supply chain because we are stocked up for the spring-summer season. It has already started, and we are able to provide our customers with a great offer that is already leading to continued strong sales. And yeah, with regards to how consumers and consumer demand might develop in the future, I think it's too early to tell. So far, we haven't seen any impact on our business.
Okay. Can I ask you about the competition then, David? TikTok Shop has been pushing into Europe. I wonder if you see that as somewhere that's going to divert demand from more traditional marketplaces. Is that something that you're concerned about?
Well, social commerce is a great channel to drive awareness, to build your brand. We also use it a lot in terms of our marketing activities to reach new consumers and engage with them. But we also know it's not the right channel to drive volume or profitable growth. We've given it a try ourselves in the UK in this past year. We also have helped several brands to try it out. And we see it's just not a channel where you can drive meaningful volume with a profit. And that's why we think also in the future, the bulk of e-commerce will still happen on platforms like Zalando.
David, you mentioned AI. I wonder how Zalando is implementing agentic AI across the marketplace, and what level of investment is going to be needed to make the platform agentic AI ready?
Well, the good news is we've been using AI for more than 15 years, so it's not a new thing for us. The platform is AI ready, and it is AI powered already. We are using it in marketing, in payments, in logistics, and almost all areas of the company. But obviously we are super excited about the rapid advancements of the technology, particularly in the last few years. And we think it will be a strong catalyst for our business going forward, both in terms of increasing our impact in the industry, but also accelerating our progress. And when we talk about that impact, we think it's going to help us both to drive growth by enabling experiences that previously weren't possible, like an even better size advice, an even more personalized end-to-end experience. But also on the efficiency side, we've seen strong traction with more AI-generated marketing campaigns on the website. Now already more than 90% of our marketing campaigns are AI-generated. We are coding faster than ever before with our engineering team. That is the largest engineering team focused on fashion and lifestyle in Europe, with more than 3,000 people. So lots of things to be excited about, and we think that will drive us forward in the future.
Okay, so you seem more excited by the AI opportunities than you were around social channels for selling. You work a lot with third-party brands, David. Do you think that your business needs a sort of own brand merchandise to try and retain customers, to create more loyalty to the platform?
Well, first and foremost, we partner with brands. More than 7,000 brands sell on Zalando and also use the opportunity to meet more than 60 million Europeans across 29 different markets. And that's really what we stand for, right? We are here to help brands be successful on our platforms and beyond with our B2B offering.
David, thank you very much. Thanks for your time. We appreciate it. The Zalando co-CEO, David Schroeder, joining us there from Berlin. As that company, Lizzy, puts out its numbers, we'll watch for maybe a bounce in that stock at the open. That seems to be what we're looking at. BMW also out with numbers. Maybe that one's flat. Daimler Truck also in the mix. We have a few earnings stories to factor in, but broadly futures pointing lower.
Yeah, Daimler's EBIT forecast missing estimates, so that one indicated lower on Tradegate. Of course, we've got to watch energy once again, all the energy names, as we see oil just below that $100 a barrel level. Once again, 95.71 is where we trade. Brent up more than 4%. We're 5 minutes away from the open. Stay with us. Futures pointing lower on both sides of the Atlantic. This is Bloomberg.
Welcome back. A few minutes to go until the start of the cash equities trading session for this, Thursday morning. Let's have a look at these markets then. This is the session of yesterday over in the US. We've got CPI data. That didn't seem to move the dial too much. Didn't cut through when really what we're all focused on is oil prices and the impact that's having on bond yields and inflation expectations. So then we kind of trod water on the US session after that. But you'll see in the European futures picture, we are expecting to go a little bit weaker. Interesting that we've got CAC futures a little bit weaker than DAX futures this morning. So DAX futures are down by 0.5%. CAC futures down a little bit more than that. I wonder if luxury stocks might be in focus. We're focused in on the impact of the higher oil price. Also, the tariff conversation is back. Some of that was in the market yesterday. Certainly, oil volatility has been a feature of these markets for some time. But we'll look to see whether we get this kind of negativity at the start of trade, down 0.4% or so on Euro Stoxx 50 futures. Then, Lizzy, the FTSE could be a little more resilient. What are you watching?
And that could be because of the exposure to energy stocks. Anna, we have seen oil higher this morning because of the latest events in the Middle East. So do keep an eye on energy stocks at the open. We also have various companies out with earnings to be minding. So Daimler Truck missing estimates on its adjusted EBIT forecast, indicated lower on Tradegate. We've also this programme heard from the BMW CEO off the back of their earnings, projecting flat automaking margin over tariff costs. And do keep an eye on the other tariff exposed sectors after President Trump's Plan B, the Section 301 of the Trade Act, being used to rebuild his tariff wall. So mind autos and luxury, as you say, an eye on Paris as we head towards the open, Anna.
So that's what we're watching as we head towards the start of the trading day then, Lizzy. Interesting with that focus on energy, because oil went once again above $100 a barrel on Brent. Energy was the best performing sector yesterday. Real estate was the worst. So will we see another day that reflects an ongoing focus on upside for energy stocks, downside for anything that is interest rate sensitive, such as real estate? So the London market getting into its stride early this morning and down just a touch. We would expect, if energy is the focus once again, that we will see a bit of resilience here in London, but it won't escape the selling, and that's what we saw in yesterday's session, certainly. So we'll see whether we get energy as the only sector in positive territory, or maybe there'll be a few others. There were a few others in positive yesterday at the end of the European trading day, but we're waiting to see where we open on the DAX. The CAC 40 actually in the mix, and actually the FTSE 100 not much more resilient, not at all more resilient than the other markets this morning. So we'll see how that market is performing under the hood. But the FTSE is down by 0.6%. The CAC 40 down around 0.5%. Waiting, Lizzy, as is often the case with the DAX to open. But we've got this, we've got the complexity of underlying earnings stories coming through. To some degree, they're a little backward looking, but we've got that dynamic rubbing up against the geopolitics, the higher oil prices, higher inflation, higher bond yields.
Yeah, the reason perhaps why the FTSE isn't outperforming as much as we might expect is that energy isn't up that much this morning. It's one of only two sectors in positive territory territory, along with telecoms. But as a sector, only up 7 basis points. Everything else in the red. Travel and leisure at the bottom of the basket, along with banks and consumer products and services, healthcare. But as you say, much of a focus on the earnings story this morning. So we've got Daimler Truck in focus, up more than 2% off the back of their earnings. It had been indicated lower, as I say, so this is a surprise. But we're waiting for BMW and Zalando to open. Just also taking a look at the luxury sector as a whole. Lots of these names in the red this morning off the back perhaps of that tariff news. So LVMH, Hermes, Kering, Burberry, all down more than 1% this morning.
Yeah, it is interesting that we, despite that futures picture suggesting we'd be weaker in Paris, that's not something that's coming through necessarily in these overall market moves. So we're down about 0.5% in London and in Paris right now, still not open over on the DAX. The FTSE MIB holding up pretty well over in Italy. It's only down by 0.1%. So we'll keep an eye on those more peripheral markets. In terms of those sectors then, defence stocks doing okay. So industrial goods and services is the best performing sector. And within that, we see that defence names are strong. So Rent Group and Leonardo both up by more than 4%. Saab, Rheinmetall, Hensoldt all up by more than 2%. And I wonder if that is a reflection of the intensity of what we've seen in the Middle East overnight. It isn't always that simple. Just yesterday, we saw that despite plenty of military activity in the Middle East, we didn't see defence names go higher. We had some earnings out yesterday as well. Let's talk about these markets in a bit more detail. We are joined now by Roland Kaloyan, who is the head of European equity strategy over at Societe Generale. Roland, very nice to have you on the programme. Thank you for joining us. So we've got another day of some negativity across these European equity markets as oil prices go higher. We're up 4% on Brent at 95.65. What is your base case assumption around oil prices, around the length of this conflict, which must be informing everything you're thinking about when it comes to equity strategy, I imagine?
Yeah, first of all, what we can say is that it's quite rational to see the European equity market down when the oil price is going higher, given the energy dependence of Europe. That's the first thing. Secondly, what is also very important is reminding where we stand up with when we have seen the start of the conflict with very high valuation, a lot of optimism on European equities. We are talking a lot about make Europe great again, and expectations were pretty high, valuation were pretty high also. So we are seeing also a kind of normalization on that front when we are looking at where the level we are now in terms of the market, in terms of the stock 600. We are approaching our first quarter target, so closer to the fundamental. So it's important also to have in mind the starting point. Regarding the movement of today, again, European equity, because Europe is very dependent on the energy side, it's very rational to see that a spike in oil price is pushing lower the indices.
It's interesting, Roland, this morning we are seeing quite a lot of the earnings stories cutting through, and I wonder what your takeaways are from this earnings season. Zalando rising on the back of earnings, JC&Co also higher on organic revenue numbers, Salvatore Ferragamo. So a host of companies where the share price is moving higher on the back of the earnings stories. Investors are making space to think about these underlying earnings stories in the context of a tense geopolitical situation. How are you leaning into the earnings story right now?
The reporting season is pretty good, I would say, in Europe. But what is important also to have in mind is that the bar was set quite low for this quarter. What we have seen over 2025 is that the earnings growth expectation has been revised down all over the year. And so for companies that are reporting now on 25, it's quite easy to beat the expectation. What I'm looking is more the guidance, the 26 expectations, the numbers. For me, they look quite high compared to the macro outlook, I would say. The expectations stand double digits, so more than 10% for the European equity market. And this is, of course, for me, something that could have an impact through 26 on European equities. So this is really where I'm putting a lot of attention now, more than the result for the Q4. It's really what the companies are saying regarding the guidance for 26.
Roland, good morning. It's Lizzy in London. If you'll forgive me coming back to the macro, we've seen the German 10-year yield at its highest since 2023 already this morning on the inflation fears. Traders increasingly certain that we'll get an ECB hike in June. How much would that hurt European equities?
Look, we have a lot of uncertainty right now, but three things that we know. I would say the first one is the longer the conflict lasts, the greater the impact will be on oil price and also on inflation. And the second thing is that central banks are on vigilant mode, on alert mode, and we have seen a strong repricing on the market expectation on the ECB. I remind you that end of February, just before the start of the conflict, the market were expecting 0.5 cuts from the ECB by December, and today we have more than one hike expected by the end of the year. So that's obviously push higher the long-term bond yield. The German bond yield took more than 30 basis points since the start of the conflict. And the third thing what we can say is that this have an impact on the valuation. Of course, you know, the valuation, the PE ratio of the market is very sensitive to what's happening on the bond yield side. We have seen some sector, long duration sector, being under pressure recently. But my point here is that when we look at the drop we have seen on the market since the start of the conflict, this is entirely a reaction to the increase in bond yield we have seen in Germany. So in some point, we haven't seen yet any increase in risk premia. And when you think that way, and when you look at the drop we have seen since the beginning of the conflict, -5%, -6%, well, and you compare to the previous drawdown we have seen recently, let's say the Ukraine war, we have seen from the peak to trough, we have seen a drawdown of 16%. On Liberation Day, we have seen from peak to trough a drop of 17%. So 5%, there is still room for more downside on the equity market, particularly as bond yield is going higher.
Yeah, indeed. You wonder if this market is being complacent about this war. But between the risk-on days and the risk-off days, are there dips that you're buying? How do you position around this volatility?
Well, we have been positioning since the beginning of the year on defensive sector because, as I said, for us, 26 earnings expectations are pretty high. Also, when I look at cyclical sector, both valuation and earnings expectation were very high compared to the macro outlook. So defensive sector like utilities, healthcare will bring you some earnings visibility, and they are trading at quite reasonable level. Secondly, even if it's not the case today, as you mentioned before a few minutes ago, I like the FTSE 100. I think, you know, the sector mix is quite interesting in this environment because you have a mix of commodity-linked sector, but also defensives. We also know that the pound could be quite under pressure in the coming month with what's going on the oil price. So all in all, we think that the FTSE 100, which is very undervalued, could be also one way to find some shelter in this market. It's relative, obviously. We are seeing today that all the indices are down, but for the ones that are managing European equities, we clearly think that there is some opportunity in the UK, but you have to hedge the currency.
Right. Okay. So that's important. You mentioned earlier on about making Europe great again, Roland, and I know that one of the themes that you are leaning into, investing around, is European sovereignty. How do you express that? What are the best ways to do that? Defence may be one of them, but that's been a sector that's already gained so much. I wonder where you see the best opportunities to still play that story.
Well, when you look what is the priority of Europe those days, and this has been highlighted in the Draghi's report, I would say it's security and defense. it's the energy dependence. It's something we are talking a lot those days. And I would say it's everything related to tech. You know that we are also importing a lot in terms of semiconductors, etc., etc. So I would say that are the three big thematic to capture this European sovereignty. What is interesting is that it's a thematic that will help investors to navigate this high uncertainty in terms of geopolitics. If you look over the last year, we have seen obviously Liberation Day with the tariff. We have seen Greenland. Now we talk about the oil shock. So that's clearly all the news. We have seen all the events are supporting this European sovereignty thematic, which has been doing well over the last year and continue to do well since the beginning of this year.
Roland, thank you so much for spending time with us this morning. That's Roland Kaloyan, Head of European Equity Strategy over at Société Générale. Well, let's take a look at the core six now, shall we? We're just discussing defence there, and Rheinmetall is one of the few gainers this morning, up 3.7% at the moment, perhaps on these signs of an escalating conflict in the Middle East. We also have LVMH here down nearly 1%, again, perhaps on luxury's exposure to tariffs and President Trump bringing into play his plan B when it comes to Section 301 tariffs. But let's get a look at some of the individual stocks that we're looking at this morning with Jennifer Creary. Jennifer.
Good morning. Of course, the big story in markets is the energy story, is the oil story. Those companies broadly flat on the open, hovering around 0 to 1%. Of course, that's after the news that the International Energy Agency had approved the release of 400 million barrels of oil reserves. The US also approving the release of oil reserves as well to combat rising oil prices following conflict in the Middle East. But investors still very much in wait-and-see mode, waiting for more kind of concrete developments before moving. Next up, we've also got Leonardo, the Italian defense company, up 7.5% on the open. That's after it lifted its full-year guidance. It also said it's pinning its growth strategy on higher margin defense electronics, one of the winners from larger European military spend following rising geopolitical tensions. Next up, we've also got BMW. Those shares are down 2.7% on the open. That's after the German autos maker said that it expects profitability to remain broadly flat for the year due to the rising cost of tariffs, but also intensifying competition in China. Now, that's not the only autos maker reporting earnings this week. We also had Porsche and Volkswagen issuing similar warnings as well. Next up, we've got Zalando, the German retailer, reporting fourth quarter earnings. Those shares are up 7.4% on the open. That's after the retailer issued a fairly bullish guidance. It also said that its first customer in its business-to-business software scale is jeans maker Levi Strauss. That's part of Zalando's efforts to broaden its capabilities beyond its customer-facing shopping platform. Those shares are up on the open. Back to you.
Jennifer, thank you. Jennifer Creary with a focus on those movers this morning. I'll add another one, and Jennifer rightly focused on the large caps there. There's another much smaller business listed in London, which I mentioned because it's moving quite a lot itself. This is On the Beach. It's down by 11.6% this morning. But I also mention it because it gives us a bit of insight into where perhaps we'll see weakness for other travel and leisure businesses. They've had to withdraw their guidance, and they talk about how the conflict is particularly impacting demand for holidays to Turkey, Greece, Cyprus and Egypt, as you would expect, I suppose, but interesting to get that confirmation. Coming up on the programme, we stick with the earnings stories. BMW expects profitability to stay roughly flat this year. We will tell you more about the story there next. This is Bloomberg.
We are an exporter. Just like Chinese companies try to export their cars, we're doing exactly the same thing. I think we have to be more confident and not to do something which endangers a global footprint of companies. The largest car exporters in the world are still sitting in Europe and not outside of Europe. We have to be confident. And I think we have, and I can only speak for BMW, we have what it takes to to conquer that competition which is coming up.
The BMW CEO speaking earlier to Bloomberg's chief Europe correspondent, Oliver Crook. And Ollie joins us now. So, Ollie, thanks for bringing us that conversation. He sounded pretty cool there, Oliver Zipse. What else did he have to say?
Yeah, an intensely serene CEO of BMW this morning. And I think that's actually kind of the message that they would like to project in a very difficult moment for the automotive industry in Germany and in Europe overall, that BMW really wants to say that we are actually the stable company in this and that we're going to actually see this weather this storm through, not just last year, but into next year. So looking into some of the results that we got overall, they managed to eke out a little bit of sales growth in 2025, which shouldn't be sort of under sort of estimated just because it's been such a difficult year. But again, looking at the individual markets, and this is absolutely key. In China, sales down 12.5%. In Americas, up 5.6%. So again, that's contrast to what we saw from Volkswagen yesterday, where last year they lost a huge amount of market share in the United States, and in Europe, up 7%. And that basically, that is the story that is going to stay consistent going into this year by their estimates. They believe that the Chinese market is going to be relatively flat, if not potentially diminish a little bit if we see the trend from last year continue. But again, they also saw their automotive margins forecast into this year between 4% and 6%. The estimates for 5.3%. So again, that is broadly in line with what analysts are expecting. That being said, I asked him about the conflict in Iran. He says it's too early to know what the impact is going to be on BMW from the side of input costs, but also from consumer demand. When we look at tariffs, he did actually put a price on how much tariffs are going to cost them going into next year. It's going to cost them 1.25% of their annual margin. That is a material impact from tariffs. And of course, the Chinese market. But the other side of the Chinese market, it's not just what BMW is selling into China. It is the fact that BYD will be, for the very first time, producing cars in Europe in the coming months. What I did enjoy from him there is saying basically a little bit of swagger, a little bit more confidence than we're used to hearing from the German auto industry, basically saying, bring on the competition, we're ready to conquer them.
Yes, and given he's leaving the business, really interesting that he's leaving in that mood. Ollie, let's talk about another German corporate reporting numbers today. Daimler Truck out with statistics and numbers for the market. How is that particular business coping with tariffs? Because they also talking about that theme.
Yeah, not particularly well, because this is a business that is truly very, very highly exposed to the tariff story within the United States, particularly because they really are a market leader on heavy trucks in the United States. So looking through some of their numbers, their operating earnings more than halved looking into last year. Deliveries were down 27%, so that's down by almost a third. And it's their Freightliner brand, which really leads in the United States. A lot of those trucks are assembled over in Mexico. That is coming under a huge amount of pressure, and they do about 90,000 in terms of volume of units in the United States. So it's something that they watch very closely, but also thinking about the Iran situation and all the effects that is going to have, not just on the auto industry. We've talked about the upstream, right? We're talking about the input costs of energy, potentially to suppliers and raw materials. For the freight sort of companies and trucking companies, there's also the downstream. So that is consumer sentiment, generally very sensitive to whether there's any sort of contraction within the sort of economy. But of course, it takes a lot of fuel to run these trucks. So the longer that this goes on, this is going to continue to be another headwind for Daimler Trucks.
Ollie, thanks very much. Bloomberg's chief Europe correspondent for Bloomberg TV, Oliver Crook there. Now, the US administration has begun the first of several sweeping tariff investigations that set the stage for new tariffs. More than a dozen major economies are being investigated, including China and the EU. It comes just a couple of weeks before President Trump is due to visit Beijing. With all of that in mind, let's talk to Jill Deesis, who joins us now. Jill, the US president setting the stage then around tariffs with a number of countries, and all of this coming just before the summit with President Xi. Is this in danger of damaging the mood?
Yes, morning. Well, I think, there's certainly other things that may be in danger of damaging the mood just as much. I mean, you've still got a lot of, tensions surrounding the war with Iran. So I do think that, there's plenty as we head toward that Trump-Xi meeting that I think serves as a backdrop there. When it comes to tariffs specifically, I mean, we did know that this was ultimately on the table. I mean, we knew this last year that, the thing with these, the original tariffs handed down by executive order, those reciprocal tariffs, is that those were to be challenged in accord. Obviously, we're now in a situation where what the Trump administration is ultimately trying to do here is to try to find something that may stick a little bit more. And by pursuing tariffs under these probes through Section 301, that's looking at things through the lens of, allegations of excess manufacturing capacity, overcapacity. Again, not something that is, new in terms of the Trump administration's criticism of some of these economies. I mean, we certainly heard this a bit during the Biden administration when it came to China, those allegations of overcapacity there. So that all kind of enters the equation here. I do think that the upshot, though, with these types of probes is that they can often take months, if not longer, to ultimately come together. So it may be a while yet before we actually see something that results from these probes that could result in some new tariffs.
And so may it be that we actually see Plan C and D coming into force as well, Jill, alongside these Section 301 tariffs? Because we know that there is the 10% and 15% tariff rate due to expire after a short period. Is it likely that the administration is going to come up with other ways to rebuild the tariff wall?
Yeah, I mean, look, the tariffs are certainly a central part of the regime here, right? I mean, this is a huge part of Donald Trump's economic plan as he headed into his second term in office. So certainly they're going to be looking at any levers that they can pull here in order to try to, bring tariffs into the equation. You've got, various different chapters that they're kind of looking at there, Section 301 being just, one of those. So I do think that this is something that obviously the Trump administration feels very strongly about. It wants to move very aggressively on, and they're going to continue to pursue those avenues no matter what, ultimately comes up. I think that this is just one of those that when it comes to this type of a probe, that's something that I think is pretty widely seen as being more legally sound, certainly than those initial reciprocal tariffs that Trump announced last year. So, they may feel a lot more confident in this kind of avenue. But yeah, I mean, I'm sure they're looking at additional, opportunities that they have in order to kind of enforce these kinds of rules here.
Jill, great to see you. Thank you so much. That's Bloomberg News Desk Managing Editor Jill Deepens with the latest on tariffs. Well, we talked earlier about those outsized moves when it came to German bund yields. In fact, they've somewhat reversed now. So the 10-year is only up a basis point at 2.93%, Anna, and the 2-year up 2 basis points at 2.39%. It just is reflective of how volatile these markets are. We're following, of course, the moves on oil and what's happening in the Middle East.
Yeah, definitely following the moves on oil, and gilt markets also responding to that. So we are up a little more on the gilt curve, across the curve, in fact. So up by 4 basis points at the short end and around the similar amount, actually, at the longer end on the gilt curve. So it does seem as if this is something that's still in the market's thinking. But yes, on the German side of things, it's been maybe moved to the sidelines a little bit for the moment. Repricing, constant repricing of the ECB based on what's happening with oil prices and what that means for the possible moves in inflation.
And, of course, that impacting the private credit story, too. So coming up, as investors get jittery, we'll discuss whether this is private credit's moment of reckoning. That's next. This is Bloomberg.
Welcome back, everybody. This is the opening trade, 30 minutes into today's session. And European equity markets, another day where we're in negative territory. The CAC 40 then is down by 0.8%. So that is one of the worst performers in terms of these major markets. A little bit more resilience was expected in the FTSE 100, but we're not necessarily seeing that. Basic resources as a sector doing OK. There are a few sectors in positive territory, but the balance of sector moves is to the downside. Banks in particular coming under a bit of pressure today. Maybe the wrong kind of inflation triggering the wrong kind of higher interest rates for the banking sector. And once again, it is a day where we are weaker on stocks, higher on oil, Lizzy, and worrying about the inflation dynamics.
Well, when we look at the breakdown of individual movers, Anna, the balance here too is to the downside. 458 members of the Stock 600 in the red, 129 in the green, and volumes are lower notably this morning. But let's take a look at the leaders and laggards today. We've flagged that defence is doing well. Leonardo in particular up more than 8%. 8%. This is also because of the positive outlook on its earnings and, of course, coming back to the Middle East tensions, adding to defence's gains as a sector. We're also keeping in mind Ferragamo in your fashion space gaining as their earnings have beaten estimates, and Zalando stock rising too on their positive earnings this morning. We spoke to the co-CEO earlier in the programme, and those shares up more than 8% as things stand. Let's turn to the laggards as well. Of course, we also heard from the BMW CEO this programme. In fact, despite him being quite cool in the interview, BMW shares down 2.4%. They say that profitability will stay roughly flat this year because of tariffs and China competition, so that knocking the stock. We also have Pandora in the red, down 2.5% because of silver easing, but also shareholders voting against the 2025 remuneration report, so objecting to an extraordinary bonus payment to the CFO. Just finally, LVMH caught in the crosshairs of geopolitics, not just the Middle East tensions, but also possibly down on tariffs. We've got President Trump's administration coming out with their plan B after that Supreme Court ruling on Trump's IEEPA tariffs, and so luxury is a sector suffering, and LVMH down 1.5%. Anna.
Lizzy, let's talk about some of the other stories we are keeping track of this morning. Morgan Stanley and Cliffwater have capped withdrawals from their multi-billion-dollar private credit funds after investors sought to redeem vastly more than the vehicles allow. Cliffwater's flagship private credit vehicle limited redemptions to 7% of shares, while Morgan Stanley's North Haven Private Income Fund capped redemptions at 5% of shares. The private credit market is facing pressure from scrutiny over the value of its illiquid loans. US Trade Representative Jameson Greer has announced that his office would begin a probe into more than a dozen major economies under Section 301 of the Trade Act, focused on alleged excess manufacturing capacity. The move marks the formal kickoff of the administration's effort to rebuild President Trump's tariff wall after the US Supreme Court decision against his global duties, with the administration planning to hold a public hearing and propose corrective actions, including tariffs. President Trump says the release of emergency oil reserves approved by the IEA will ease energy price pressures as the US seeks to, quote, finish the job in Iran. Meanwhile, Bloomberg has learned that leadership in Iran has told regional intermediaries that for a ceasefire, the US must guarantee that neither it nor Israel will strike the country in the future. Lizzy.
Well, the Iran war is producing significant global uncertainty in a period which is already seeing seismic shifts in tech driven by AI. That's the complex environment forming the backdrop to Citi's flagship EMEA Tech Conference in London. And you might be wondering where Tom Mackenzie is. Well, our Bloomberg Tech Europe anchor, Tom, is there. Tom, we miss you. Who are you with?
Lizzy, thank you very much indeed. Yes, at the City Disrupt Tech event here in central London. And alongside me is the Chief Technology Officer of Humanoid. It is a London-based robotics company focused on industrial robotics for companies like Siemens, like Schaeffler. They have partnerships with the likes of Ford and SAP. They have a collaboration with NVIDIA as well. Jared Cannon, then, the CTO of Humanoid. We're talking about the global volatility right now. The focus, of course, with the unrest, the Middle East crisis, the war in Iran and supply chains, but also, of course, the developments around AI and software and hardware. And this has been pitched by some in the tech space as the year for humanoid robots. Where are we? Given all the complexities of what's happening on a kind of global stage, where are we from moving from lab-based humanoid robots to actually real commercial uses, Jared?
Yeah. I think we're going to see real commercial uses starting later this year and going into next year for these systems in industrial spaces. So like in fairly well-structured, repeatable type use cases, the technology is there today. The AI systems are general enough to be able to learn these tasks, not just a single task, but multiple tasks inside these facilities, which really is what unlocks the commercial viability of them. This flexible type automation. There are still plenty of roles for specialized systems, static arms that just pick 24/7. But where you really benefit with a humanoid is this flexible automation, being able to move from one use case to the other within a single facility.
So for you and for Humanoid, the company, this happens this year.
Yes.
Which industries are you going to be deploying into? I mentioned some of the names there.
Yep.
And what is the demand that you're seeing already?
Yeah, the demand is off the charts, which has been honestly surprising for me because I've been in the robotics space for about 15 years now. And normally you have to kind of pitch them on it. What I've been seeing is in a lot of cases, these companies already have humanoid strategies. They are figuring out in advance of the technology being available to them commercially, how are we going to use these to augment our workforce? So the demand has been there. We've completed 8 commercial POCs with our prototype systems. We're working on our production intent systems right now. The first systems for the production intent design are coming online later this year.
And how many units do you expect to be shipping, say, by the end of 2027? Do you have a target in mind?
Yeah, basically high hundreds to low thousands is the target by the end of 2027.
What is driving that demand? Is it a shortage of labor? Is it because the unit economics now make more sense when it comes to robotics versus humans? What is driving that, what you describe as significant demand?
Yeah, I would say the biggest signal we're getting is shortage of labor. So the use cases that we're going after are in warehouses, in logistics facilities, in automotive suppliers and so forth. And these jobs are sometimes in areas that are just very hard to staff. And even the ones that are in the more densely populated areas, they're just not the jobs that Western society is going after right now as heavily as they had in the past. And so these are allowing us to augment the labor force in a way that just wasn't possible with more specialized automation before, because the ROI wasn't there. For a single use case, if you need to dedicate a robot for that, you need maximum usage of that system. But a lot of these are kind of sporadic use cases throughout a facility. Maybe I'm unloading in the morning, maybe I'm packing during the day, maybe I'm loading at the end of the day, and you need a flexible automation solution to be able to support all those use cases.
Ultimately, long-term, jobs do get replaced, though. I mean, which jobs are going to be replaced most quickly by humanoid robots?
I think anything extremely dull or dangerous is what we're going after right now. So some of the use cases that we've been working on as well are in high energy stations where literally people die during the year, and this is like a major problem that they are trying to basically take humans out of that use case so that they're no longer exposed to some of these risks. So yeah, all the very repeatable, fairly narrow complexity use cases are what we're initially targeting.
There's a lot of money going into robotics right now, a lot of money going into humanoid robotics. It's very competitive.
Yes.
Does China end up winning this race, Jared?
Yeah, it's a great question. I think China is very strong on hardware. They can iterate extremely quickly in places like Shenzhen. They have basically everything they need right in that location. But I would say what I expect to see happen is, on one front, some of the parts will get commoditized, but this has happened in the automotive space as well, and yet a Porsche is not a commodity. So I think that parallel actually also applies to humanoids. Some of the parts will get much cheaper, which will help the ecosystem be able to create more of these systems and deploy them in the world. But in terms of Chinese full systems, what I've seen in the space over the past 5-ish years is that a lot of US customers, UK customers, European customers are always asking what components in your supply chain are coming from China. And I do think there is going to be this sovereign element to which humanoids are adopted in which regions. So this
becomes another sovereign story.
I think that's exactly right.
Humanoid robotics. Where does Elon Musk sit in this? The Optimus. How do you grade that robot and his chances of success?
Yeah, I think one of the major differences between us and almost all the other competitors is we started with a commercial focus in mind at the right time, right as the AI systems were coming online to actually make them commercially viable. Almost every company that started before us was more starting from a research standpoint. You think about the Boston Dynamics and some of the others, they have long research histories. And so, in terms of Optimus, it's an impressive looking robot. It's not competing for the same types of use cases that we're going after. It's much smaller. Its payload capacity is much lighter. It has a 5-finger dexterous hand, which are very complex and they're very expensive. Our system is simplifying where we can. So we've got a wheelbase. There are existing autonomous mobile robot standards that enable us to get the safety certifications to deploy them into customer facilities. We use simplified gripper systems because it helps us use or complete most of the tasks that our customers care about. And we have a much larger workspace and a much higher payload capacity than any of those bipeds.
Elon Musk is a major threat at this point.
Not at this point. And I don't think there's going to be a winner-take-all dynamic. I think this market is huge, and there's going to be many players in the space.
Jared, thank you very much indeed. Really fascinating views and insights in terms of what's happening with robotics, humanoid robotics. The CTO of Humanoid, Jared Cannon. Guys, back to you.
Tom, thank you so much. That's our very own Tom Mackenzie. Well, as we've been hearing, a jump in private credit redemption requests has forced Cliffwater and Morgan Stanley to cap withdrawals. Let's get back to the private credit conversation now. Joining us is Sinead Cruz, senior editor of Bloomberg's Going Private newsletter. Sinead, so we've seen these redemption requests and the capping at Cliffwater, at Morgan Stanley. It was previously BlackRock. Is this a snowball effect? Is it like every time it happens, sentiment sours and we can just expect more and more?
Yeah, I mean, it has been quite a fortnight for private capital. And yes, we have seen a wave of redemptions from significant funds. And not just funds managed by anybody, funds managed by BlackRock, Blackstone, Blue Owl, and now Morgan Stanley and Cliffwater. And you have to ask the question, where does the negative sentiment stop? It's tricky to answer that because the key issues in private credit remain. It's got a problem with opacity, it's got a problem with liquidity, and yet there are still many, many retail investors exposed to this sector who are now getting nervous about the scale of the sector's exposures to software. As we've just heard.
I mean, one of the features of this market is that it's private. It has lower transparency, and it is some of these assets are deliberately supposed to be locked up for a while, aren't they? So that you can't get your money back, which is such an interesting dynamic of all this. But I note that some in the private market space are trying to increase transparency a little bit, thinking that might calm nerves. What are we seeing being done?
Yeah, so we have heard for very many months people like Apollo's Mark Rowan mount a defence, a robust defence of the asset class, saying that all these allegations of opacity and untimely evaluations are not right. Now, what's the first lesson we learn in journalism school is show, not tell. And Apollo are trying to do exactly that because they're now looking to provide much more regular insights into the values of their assets. They'll start, hopefully, by valuing those assets on a monthly basis before progressing then to daily NAV valuations. That should, in theory, help to calm some of the nerves that investors have about the performance of the assets they're exposed to.
Sinead, is it fair to say that this is less of a problem in Europe than it is in the US? That's what the M&G boss was telling us earlier in the programme. And he was saying that they're less exposed because they have less exposure to retail investors. Is that the way to protect yourself, to just go the institutional?
And less exposure to software stocks in the sort of underlying assets. He was saying, less involvement of retail, a less crowded private credit market. All of those reasons. Yeah, for sure. I mean, the US market is a lot more sophisticated, a lot more evolved and mature than the European market. But that doesn't mean to say that European funds will not have similar problems with managing sentiment here. Who knows? I mean, when the retail investors act, then, we might actually see institutions start to withdraw some of their support from the sector. We're already seeing some banks start to peel back support. JP Morgan is now restricting some lending to private credit funds following some markdowns in some software-related loans. The private credit market cannot afford to lose the confidence of investors and the banks. Yes, that's interesting. So, because I was wondering, if it's in the terms and conditions that redemptions can be capped, because you need to match the duration of the assets with the liabilities to the investors. I mean, at some level, you ask, well, why can't they just enforce the caps and say, well, we said that's what we do because you can't have instant access? Yeah. The problem is when you enforce caps, sometimes that can amplify worries about problems that aren't actually even there. Now, we are seeing some modest increases in default rates, some modest increases in non-accrual rates, which tracks the amount of interest being paid on loans. But ultimately, lots of these assets are still performing. And when you have a massive rush to the exit and these funds, those managers, in order to meet those, might have to fire sell assets, which is not what they want to do. Capping the funds as per the terms and conditions is probably the best way to keep and protect those investors in the funds. It may not be to everyone's liking, but it's probably the sensible move. OK, a difficult balance to strike. Sinead, thank you so much. That's Sinead Cruz, senior editor of Bloomberg's Going Private newsletter, which is published twice a week. Just go to bloomberg.com/newsletters to subscribe. coming up on the programme, 2 crude tankers are attacked in Iraqi waters. We discussed the potential for oil prices to head above $160 a barrel. That's one forecast we've been digesting this morning. That is next. This is Bloomberg. Welcome back to the opening trade. 49 minutes into a European equity session that is negative on the back foot, down by 0.4%. Off earlier lows, though, it does seem. We have the FTSE 100, the CAC Iran, both down by 0.4%. The Xetra DAX actually doing a little bit better. Some of the defence names in Germany on the rise this morning. Now, oil could approach $164 a barrel if the Strait of Hormuz is closed for 3 months. That's the view of Bloomberg Economics, which has been modelling the potential duration of the war and what it means for energy prices. One of the authors of this report, Ziad Daoud, joins us now, Chief Emerging Markets Economist for Bloomberg Economics, and with us on set here in London. Ziad, really nice to have you with us. Talk us through then the analysis that you've been doing and the scenarios that you have been sketching out.
Sure. So as far as the war is concerned, it's no longer about intensity. Every day we lose about 20% of global oil supplies. If that's not the largest supply disruption in recent history, it is one of the largest. So the question now is not about intensity, it's about duration. And we model duration. We ask the question, what would happen if the Strait of Hormuz is shut for 1 month, 2 months, or 3 months? And the results are fairly clear. Oil needs to be above $100 per barrel with the shutdown of the Strait of Hormuz. If it's shut for 1 month, we expect prices to be around $105 per barrel. If they're shut for 3 months, we're talking about $164 per barrel. Now, you'd expect maybe with such a large supply shock that the impact would be larger. But economies do adapt. With high oil prices, you get demand destruction, you get more supply, people find alternative routes, and maybe even the war ends with high prices.
But Ziad, keeping the strait closed is surely Iran's leverage here. President Trump can declare an end to the war, but he can't reopen the strait. What's your base case then when it comes to oil?
That's basically our view on the war as well. We don't think the war at this intensity can last for many more weeks. There are so many costs there, and things will move to either a ceasefire or still warfare, but at a much lower intensity. And what would end it? We think 3 things could end the war. 1, economic cost, that's mainly coming from high oil prices. 2, equipment. If Iran runs out of drones and missiles, if the Gulf runs out of defense equipment, that could bring an end to the war. And the 3rd thing is popular opinion in the US. If that starts biting, then President Trump can maybe claim victory and declare an end to the war.
It's interesting thinking about the war and this very kinetic phase of it that we're in, and the Straits of Hormuz, and wondering if you can disconnect the two. It was interesting, I was reading some Bloomberg opinion piece recently talking about if there are mines, and we are not necessarily clear on that, but if there are mines, it could take months to fully clear them. So I suppose that takes us to thinking about this lasting for a little bit longer, at least the closure of the strait. So how do you go from your $164 oil to the impact on the global economy? What does that look like, Ziad?
Obviously, the link is oil prices, and oil prices do 2 things to the world. They lift prices, consumer prices for everyone, and they shift incomes from oil importing nations to oil exporting nations. And that creates sort of different impacts for different countries. So if you're in the UK, if you're in Europe, we actually put that in our shock model, and we find that oil prices at 110 would create a GDP drag of around half percentage point and an inflation increase of about 1 percentage point. If you're in the US, because you're now a small net oil exporter, you don't get the GDP hit, but you do get the inflation hit. If you're an oil exporting country outside the Middle East, importantly, if you're Russia or Canada or Norway, then high oil prices are basically increasing your oil revenues, increasing your exports. You're a net winner from the current situation.
Ziad, happy to have you with us here in London. Ziad Daoud, Chief Emerging Markets Economist for Bloomberg Economics. Thank you. Well, European natural gas opened 7% higher as prices caught up to the latest supply disruptions in the Middle East. That gas price is the equivalent of around $100 a barrel of oil. So let's bring in Adam Linton from Bloomberg's Markets Live team for analysis. Are you surprised, Adam, that gas prices maybe haven't been at crazy levels?
Well, not necessarily crazy levels, because obviously there has been an element of adaptation since the Russia and Ukraine crisis. But, I still do think that the upside risks do remain. I think if you look at the reaction to the IA reserve release yesterday, that was very much a market which is conditioned towards expecting this to be a more drawn-out affair than it hoped for. And the tenor of news flow remains relatively negative. We've seen those tankers attacked in Iraqi seas. We've seen the Oman export closures. We've seen Chinese refiners go back on some of their export commitments. And, the terms of an Iranian ceasefire that we saw last night do appear to be a relatively high bar. They want no attacks from the US or from Israel. And we've not really seen anything to suggest that will be the case. And so as such, the market is still conditioned towards trying to figure out where this off-ramp lies. And it still remains a relatively high bar.
Yeah, it's interesting. I mean, Christine Lagarde was talking about how this isn't 2022 and oil prices haven't gone up to the same gas prices haven't gone up to the same levels that we saw in 2022. And Bloomberg New Energy Finance were out with a report talking about increased resilience and sovereignty since then. But it's all sort of a bit more rather than fully sovereign and fully resilient. So we've got higher gas prices. What does all of that mean for bonds then, Adam, and the inflation story, the ECB notably here in Europe?
Yeah, I mean, I think European bonds are set to continue being marked lower. Obviously, we've seen the energy implications for inflation are quite obvious. And what we've seen now is obviously traders ratchet up ECB hike expectations. Then yesterday we saw some ECB members begin to give, some validation to these bets. We saw ECB's Casimir suggest a rate hike could be sooner than we think. And, whether the ECB hikes or not, ultimately we are seeing a tightening of financial conditions. But, I kind of think that ECB will potentially be more reticent to hike rates at this juncture. I know there's parallels between now and 2022. That was a very different landscape. The deposit rate at the ECB was negative 50 basis points. We're now at 2%. So, at the time, there was a huge element of catch-up. And if you are the ECB, your deposit rate's at 2%, what do? Do you go back to 4%? There isn't really clearly an end game. And also the ECB, there's clearly a growth concern as well. We saw messages from the EU yesterday that prolonged energy prices at these levels could lead to a 40 basis point hit to economic growth. So I think that's also weighing on policymakers' minds as well.
OK, Adam, thanks for the update. Adam Linton there from our Markets Live team. Well, it's all our parts of the market being touched by this once again, Anna, but volatile every day this week.
Yeah, absolutely volatile. Energy prices once again in focus. Oil prices 97.73 on Brent. Interesting talking about the bond markets. Our guest at the beginning of the programme saying, yes, they're putting inflation front and centre now. In the future, maybe we pivot to putting growth front and centre, and that provokes a different reaction in the bond markets. But at the moment, it does seem as if bonds are focused on that inflation drive.
Yeah, and the question remains, how long is this going to go on? You have that imbalance between how much it costs to launch a drone and defend against a drone, but no one wants the Strait of Hormuz closed. That seems to be the main chip, the piece of leverage in this war. But that does it for the opening trade. The brief's coming up next. This is Bloomberg.